Let's talk about the 2026 housing market. You see one headline that says prices are cooling, then the very next one says it's impossible to buy anything. I mean, if you're getting whiplash trying to figure it all out, you are definitely not alone. So in this explainer, we're going to cut right through all that confusion and give you a clear map of what's really going on.
So let's just rip the Band-Aid off and tackle the biggest question head-on. Are we staring down a housing market crash, or is this whole thing just a really long, slow correction? It's the one thing everybody wants to know, whether you're thinking about buying, selling, or just trying to figure out what your own home is worth.
You know, the good news is we don't have to guess. The best antidote to all the fear and uncertainty in the market is solid data. So our mission here is really simple. We're going to cut through the noise, look at the actual numbers, and see what the leading experts are forecasting for the road ahead. All right, here's our game plan. First up, we'll piece together the 2026 housing puzzle and see why everything feels so confusing right now. Then we'll hit the big three: home prices, mortgage rates, and of course, inventory. And we're going to wrap it all up with an actionable playbook designed just for you, whether you're a buyer, a seller, or a renter. So why does this all feel so weird? I mean, on one hand, you hear about recession warnings and maybe a shaky job market. But on the other, the stock market's hitting records and the economy is technically growing. You know, these aren't just conflicting signals. They're a sign that we're not in a normal economy at all.
The key to unlocking this whole puzzle is a concept called the K-shaped economy. Just picture the letter K in your mind. One arm shoots up while the other one trends down. It is the perfect metaphor for what's happening right now, because different families are on completely different economic paths.
And this is where that divide just becomes crystal clear. On that upper arm of the K, you've got more affluent households who are seeing their wealth grow, plus all those homeowners who locked in those crazy low mortgage rates a few years back. But then, on the lower arm, you've got younger households and renters who are facing rising debt and a much tougher job market. This single split is the key to understanding the entire housing market.
Which brings us to the main event, home prices. With all those pressures on that lower leg of the K, you have to wonder, are prices finally going to come crashing down? Well, let's see what the data has to say.
The answer is, well, not really. The consensus forecast from major players like Zillow and Redfin is for national home prices to go up, but only by about 1% in 2026. So let's be clear, that's not a crash, but it is a huge slowdown. Basically, flat is the new up.
So you might be thinking, hang on, why isn't this just a repeat of 2008? Well, the fundamentals today are totally different. We still have a shortage of homes for sale, and maybe more importantly, homeowners are in a historically strong financial position. The average homeowner is sitting on over 50% equity in their home. That means there's no risk of those widespread foreclosures that would cause a price collapse. That equity is like a giant safety net for the whole market.
Okay, so if prices aren't dropping, how does housing ever get more affordable? The answer isn't some dramatic price crash. It's a slow, steady grind. As you can see here, the price-to-income ratio is gradually, and I mean gradually, improving. This is happening because incomes, which are rising about 4% a year, are slowly catching up to home prices that have pretty much flatlined. So affordability is getting better, just at a snail's pace.
And this brings up a really crucial point from one of Zillow's top economists. The housing market is almost impossible to time. The takeaway here is so clear. Trying to wait for that perfect, magical moment to jump in is a losing game. The right time to buy is when you find a home that fits your family's needs and, most importantly, fits your budget today.
Of course, you can't have a conversation about affordability without talking about mortgage rates. After years of just wild volatility, what can we actually expect in 2026? Well, the magic number everyone has their eyes on is 6%. The expert consensus from big groups like Fannie Mae and the Mortgage Bankers Association is that 30-year fixed rates are going to hover right around that mark, averaging somewhere between 5.9% and 6.4% for the year. A huge drop below that just seems pretty unlikely, unless we see a major economic slowdown.
So why is that 6% number so important? Well, because a really fascinating psychological pattern has popped up. As this timeline shows, every single time mortgage rates have even gotten close to that 6% mark, buyer demand has surged. It's not that 6% is historically cheap, but after everyone got used to rates over 7%, it feels like a deal. And that feeling is enough to pull a ton of buyers right off the sidelines.
And that rate psychology leads us right into the famous lock-in effect. For years, anybody with a 3% mortgage basically felt trapped. They weren't willing to sell and take on a 7% loan.
But that grip is finally starting to loosen. As more time passes and, life happens, the number of homeowners willing to sell is slowly starting to grow, and that is a critical trend that should help ease the inventory shortage over time.
So as that lock-in effect starts to fade, we should see more homes for sale. But where those homes start popping up is the most important part of this whole story. Because if there's one rule in real estate, it's that everything is local. The national average tells you almost nothing about what's happening on your street.
And in 2026, we are truly seeing a tale of two different markets. In Sunbelt states like Florida and Texas, a big boom in construction has caused inventory to rise sharply. This is fantastic news for buyers, who finally have more options and some power to negotiate. But in the Northeast and the Midwest, it is the complete opposite story. A severe lack of homes for sale means it's still very much a seller's market, with really tight competition.
So the crucial point to take away is this. Your experience in the 2026 market is going to depend almost entirely on where you live. That national story of a calm or flat market completely hides these intense local differences. You really have to zoom in. Okay, so what does all this mean for you? Let's boil all this data down into an actual playbook you can use. This is the So What, a clear, simple plan for navigating this new era of housing.
We've broken it down into 3 simple steps, depending on what your goals are. For buyers, the message is to get ready. For sellers, it's all about being realistic. And for renters and investors, the key is to be strategic.
All right, buyers, listen up. Your mantra is get ready. First, know your numbers cold, and I mean focus on the total monthly payment, not just the sticker price. Get pre-approved early. It's your ticket to being taken seriously. And remember those regional differences we talked about? In many parts of the country, buyers finally have the upper hand again. So don't be afraid to negotiate on price, on repairs, on other terms. The power is shifting back.
Now for sellers, the message is simple. Be realistic. The gold rush is over. Those days of listing your house on a Friday and getting 20 offers by Sunday, yeah, those are gone in most markets. That means you have to price your home competitively right from day one and make sure it is in pristine condition to stand out. Be ready to negotiate. In this market, a great local agent isn't a luxury, it's an absolute necessity.
And finally, for all the renters and investors out there, if you're renting, this slower market is actually your friend. It's the perfect time to build up your savings and watch for opportunities without feeling rushed. For investors, the game has completely changed. Forget about those quick speculative flips. The winning strategy now is all about buying for long-term positive cash flow. Discipline is the name of the game. So, after years of pure chaos, the housing market is finally entering a new, more stable era. It's not a crash, but it's not a boom either. It's a reset. And that brings us to our final question, which is really the only one that matters. The market is stabilizing. Is your plan ready?